welcome everyone. Thank you for attending this webinar. For those of you who don't know me already, I'm Imran Larka. If you could get yourselves on mute, that'd be great. Thanks. So yeah, I've worked for some of the big banks on Wall Street over the years for like a couple of decades, where I ran equity derivatives trading desks. I also have taught a bunch of young traders and not so young who have gone on to become senior and successful in the banking world and even the hedge fund world. And a lot of them are still trading today. The point of this webinar today is to give you guys a sense, an insight into the world of crypto options. And, you know, it's a really exciting space that I personally entered into about a year ago because I saw an opportunity to apply my options knowledge, which is pretty transferable across asset classes, to a growing market where the volatility of the asset was really large, but also the volatility of the vol was also really large. And once you learn a bit about options, you'll see that that combination of high vol asset and high vol of vol is a bit of an option trader's dream, right? So throughout this webinar, please feel free to put questions on the chat. I'll be monitoring those. I'll do my best to answer them as we go along. I want you guys to get as much out of this hour as you can. And, you know, feel free to turn your cameras on. Don't be shy. Let's try and make this interactive and as fun as we can. Yeah. It's always nice to have a few faces to kind of look at as well, rather than just names. Before we start, I do need to give a quick disclaimer. There is, you know, none of this is financial advice. It's for education purposes only. Yeah. So with that, why don't we start off by kind of asking you guys a few questions. And basically, if you want to put on the chat, or feel free to kind of speak now as well, some answers to the following questions, right? So they're up on screen. Okay, so there we go. So how long have you been trading? Have you traded options before? Do you own Bitcoin or Ether? And what do you want to get out of this webinar? So just stick your answers on the chat, or feel free to just shout them out as well. Okay, cool. So that gives me a sense. So, okay, so the next thing is, I just wanted to talk about, so why are so many people getting into trading, right? So what are the benefits of trading? We've obviously seen the explosion in trading over recent sort of year or two. So why are so many people trading? And, you know, well, it allows them to work from home. Obviously in this environment, that's been quite important, having that ability. People are looking for additional sources of income. People want to grow their wealth for the future, so they've got into investing in stocks and things like that. And markets have been moving around a lot, right? So, you know, where we had 2017 and the previous few years before that, markets were dead. You know, after the crash last year, everyone got interested because things were moving. So a lot of people have got into trading, and those are like the main reasons, right? What about, now the problem with trading is you hear all these scare stories that 80% of retail traders lose money. So what do we think about that? Me, personally, I don't think you have to be a professional to make money. I just think you need to do a few things, right? So if you work hard, and what does that mean? That means get yourself educated. That means, you know, practice, refine your process, have a framework, evaluate yourself regularly, be intellectually honest, so you know what you're doing well, you know what you're doing badly, and just continually work at getting better. I think that's what I call working hard, right? Using strict risk management rules, right? Very important, risk management in trading, right? The trick is you're not always going to be right, but if you lose less money when you're wrong and you make more money when you're right, over the long term, you're going to be a profitable trader. You got to stick to those rules, right? You've got to stick to those rules and you've got to exercise discipline, right? Which easier said than done at times, because trading can be a bit of an emotional roller coaster for some, and they don't necessarily always feel like sticking to their rules, right? And then the last one, getting some guidance. Get some guidance from people who are more experienced, you know, handful of people who you like what they have to say, that you like their process, and try it out, right? Try out different seasoned traders' processes and the way they look at it, and you'll find something that works for you, and you'll find something that resonates with you, and that helps you find your style, because, you know, not everyone's the same in the way they like to trade. Yeah. So then the next question, why options? Why so many people trading options, and why are we going to talk about options today?
Right.
So for me, the thing I really want you to take away is that using options gives you an additional tool, okay? An additional tool to your toolkit. If you've been a trader for a while, you haven't really dabbled in options, but you've been buying and selling, going long and short, this makes your trading much more multi-dimensional and gives you a lot more tools in your toolkit, okay? So whether it's you're looking for an alternative way to speculate on the future price of your asset, and in this case, let's call it crypto, but with limited downside, right? When you buy options, the good thing is you have limited downside. You know how much you can lose. You've made peace with that, and then you can let the trade play out, right? So it gives you the ability to control your risk because you know exactly what you're spending, okay? Another thing is getting leverage to your capital, right? That means for a relatively small amount of starting capital, because options can multiply in value, then you get leverage to that, right? You don't need as much starting capital as maybe you would need if you're getting into stocks, because you can participate in these moves with a smaller amount of actual cash. Earn income from existing positions. Systematically selling calls, for example, called covered call writing. Very, very popular in stock trading and in stock options, but no reason why you can't do that in crypto. You know, if you've got a long holding, you've got a core long holding, selling call options to earn income against that is a very, very popular and very profitable strategy a lot of the time. Then hedging. Hedging for me is one of the biggest uses of options. You know, we'll talk about the actual types of strategies you can use, but you know, options don't need to be more risky, right? Using options to hedge your portfolio actually gives you peace of mind. So you don't have to stare at the price all day, especially at the weekend, right? If you've got a crypto holding and you've made a bit of money over the last 6 to 12 months, you know, having some puts, having some hedges against it allows you to not worry about those 30% crashes that can happen over the weekend, right? You're in a position of strength. You know what's going to happen to you. Yeah. And then the last one is really trade the volatility, right? Volatility, a lot of traders who don't understand options, they get spooked by volatility, right? They find it as a nuisance. It makes them kind of a bit nervous, and it makes them freeze, and it makes that choppy trading kind of makes them question their views. If you know how to trade options and you know how to look at things, you can actually benefit from volatility, right? And that again, adding that to your toolkit makes your trading more multidimensional and lets you embrace volatility rather than be scared by it. Yeah. Okay, so that's kind of me rambling on about options and why they're so great. Okay. Now let's get to the bit you've all been waiting for, which is crypto options, right? So the platform that we use is Deribit. That's the exchange for crypto options that has been around the longest. It's the one that has the most trading volume, and that's the one that I've been using for roughly a year now. So what I'm going to do is I'm going to share my screen. I'm going to open up the platform, and we're going to have a little look at the front end and what it looks like. Okay. I have got affiliate link there. I'll whack it up on the chat as well later, just so you have it if you fancy having a look at Deribit. Gives you a 10% discount on trading fees for the first 6 months if you were to use that. Okay. So let's have a look. Okay, so this is Deribit. This is what it looks like. So it's a futures and options exchange. Okay. And you've got basically the two assets, Bitcoin and Ethereum. They're the only coins that you can play with on this exchange. Okay. And the way this works is that the actual wallet, the actual account that you have at this exchange is a crypto wallet. So you have to have Bitcoin or Ethereum in somewhere like Coinbase or whatever, and you have to send that over to a crypto wallet within this exchange when you sign up. Okay. And all your margin that you put down against any trades you do is all denominated in crypto. Okay, so there's no fiat currency in this platform. Okay. Now the futures you see here, we've got futures along the left hand there. That's all the different maturity futures there are. So you have perpetual futures, you have all these other expiries, short dated, slightly longer dated, and you can see that whilst the spot price of Bitcoin is about 54,500, these futures, the further you go out, the price of those futures is increasing. Okay. And that's what you call funding. That shows you, that's the funding between the price, the basis between the futures and the spot. That's called the futures basis, and that is due to funding. So what that means is people are willing to pay a higher price to own the futures than have to physically buy the crypto. Okay, because when they just buy the futures, they're buying on leverage, right? They don't have to have as much money because they just have to post enough margin to be able to have that position. Okay. And how expensive or cheap those futures trade relative to the spot is a function of the supply and demand of that leverage, basically how much demand there is for that leverage. So actually last weekend, when the market tanked, it was partly because there was too much leverage in the futures market. Yeah. And there was a very, very high basis between spot and futures. And as the bad news started to hit the tape, some of that excess leverage of speculative longs got flushed out, and you had a lot of liquidations in the space, and it was driven by futures. And the reason you could see that was because the spread between futures and spot actually collapsed and even went negative briefly, right? So some of that leverage was being unwound, and that's why you were seeing some of those wild swings over the weekend. Yeah. So that's the futures, but we're not here to talk about futures. We're here to talk about options, right? So the next bit is you have all the options and all the different expiries. You can see the first expiry we've got is the 23rd, which is 1 day. And so you've got 1 day and 2 day options. You've got 1 week options. You've got, various different expiries. Now, generally, the options that tend to trade in the most volume and have the most open interest tend to be the end of month expiries, and it tends to be in the first couple of months. So right now, you'll have a bunch of options expiring on the 30th of April, then the 28th of May and the 25th of June will probably be the biggest expiries where a lot of activity is going on, basically. Okay. So that's kind of the expiries. And now if we click into the 30th of April, for example, yeah, this is what you call an options chain. So in this options chain, we have calls on the left and puts on the right. And we have the strikes down the middle. So this is just showing us in one page for all options that expire on the 30th of April. This is showing us the prices, bid and offer. So again, for those who aren't familiar, but I'm assuming most of you are, bid and offer is the price where you can buy or sell, where the market makers will buy or sell. So for example, if you wanted to buy something, you were going to have to pay the ask. And if you want to sell something, you're going to have to sell the bid. So this tells you the bid offer of all the options for that maturity across all these strikes. So if we look at the first option maybe to look at is what we call the at the money option, which is the one with the strike equal to where we currently are trading. Okay. So where we're currently trading, if we go to the April futures contract, is about 54,000, let's say. Okay. Which means your at the money strike is pretty much this 54,000 strike. So then we can say, well, how much are the at the money calls? Well, the at the money calls are 2,100 at 2,180. So that's the two-way price, okay? And that's the dollar price, right? That's the dollar equivalent of what those options cost. Now, you don't actually pay dollars for it, because like we say, everything you're doing is in crypto terms. But because your strike price is 54,000, that's how many dollars Bitcoin is worth. So you want to know what the price of the option is in dollars as well to get a sense for what the price is and what it's worth, okay? So that's the price right now of those calls. Whereas the puts, if you have a look, they are 1,600 at 1,700 roughly, okay? So they're different prices for the calls and puts. What are calls and puts? For those who don't know, a call is the right to buy Bitcoin in this case at 54,000. And the put is the right to sell at 54,000 at maturity being the 30th of April in this case. Yeah. So this is where, this is what we're saying, you could, if you had $54,000, you could buy a Bitcoin, right? But say you don't have that much money, you could buy an option to buy one Bitcoin for only $2,000, which is a lot less money than $54,000, right? And so, and if Bitcoin then went to 70, 80,000, you would make money being long that call option that you only spent 2,000 for, because you had the right to buy it at 54,000 and it's trading way above that. And the value of that option will increase to reflect the fact that you get to buy it at 54,000, even though it might be trading at 70, 80,000. And the price of the option that you paid $2,000 for has gone up 10, 20,000, whatever it is, right? So that's how you get participation in those moves and you get leverage to the money that you're spending, okay? So this is why, people who haven't owned Bitcoin for the last sort of year and have missed out on owning it in the 10 to 12,000 area, they don't want to pile a load of money into Bitcoin here and risk it dropping by $30,000, right? So the point is, one very, very simple way of looking at it is to say, well, I haven't made that 20, 30 grand that I should have done if I bought it back in last summer. But if it keeps going up to 100,000, if I want to participate in that, I can maybe buy some call options that don't cost me too much, that cost me $1,000 or whatever. Like which option costs $1,000 right now? Right now, and remember, this is the expiry for the end of the month, right? Which is only, 8 days away. But let's say, for example, if you thought we had a shot at going to 100,000 by September, right? You could look at September options, you could see where the call options are there and how they price. So the 60,000 strike call option costs about 12 grand. The 80,000 strike costs about 6.5 grand. So obviously these options are quite expensive because they factor in the fact that Bitcoin has the potential to rally a lot or move a lot. So they're not going to give you these options for free. But the point being, it enables you to put a little bit of premium down and participate in the potential upside that this thing could have, okay? So that's one simple way of thinking about how you could participate in a rally by owning call options, out of the money call options that were relatively low in premium, but could go up 5, 10-fold if we continue to get the bull market that we've been seeing, basically, okay? And, the kind of price targets that a lot of people have in this space are astronomical, right? So maybe that still makes sense to do, right? The type of trade, I generally haven't been just a naked call, but that's called being long naked calls. I haven't generally been a naked call buyer. I did buy some naked calls in Ethereum last year because I believed Ethereum really had some crazy upside potential. So I thought it made sense, and that ended up working out obviously well, yeah. But it's not what I generally do now. Now that I've been in it, now that I've kind of participated in the rally, that's not my mainstay in terms of the trades that I'm doing, basically, okay. So what trades am I doing, right? For me, the big one is hedging. So if you've been similar to me and you got in sort of last summer and you were watching Real Vision, for example, and you had Raoul going on about why you have to have some Bitcoin in your portfolio, and then Paul Tudor Jones joined in, and then Stanley Druckenmiller joined in, and you're like, yeah, I'm going to have to pay attention at some point. And and you did manage to accumulate and you've done pretty well, you're now probably thinking to yourself, well, if it goes to 100,000, I still want to have it. I don't want to get rid of it, but I've already made 4 times my money. So what do I do here? I don't want to exit a position, even though it's made me 4 times my money, okay? Because it could double again, right? But I also don't want to give it all back if it goes down to 10, 20,000 again, right? So that's where these options allow you to get peace of mind, right? So the type of strategy, the most common strategy for me is I'm always long, I'm always buying some out of the money puts in the kind of 6-week area, right? And so let's have a look. So in the 6-week area, which would pretty much be the end of May, in the end of May expiry, you could buy the 50,000 puts, and we're trading at 54,000. So they're 10%, less than 10% out of the money, okay? You could buy the 50,000 puts at 2.5 grand, right? So just think about that, right? If you've owned Bitcoin, if you've owned one Bitcoin from 12,000 and it's ridden all the way up here, right? And you've made, 40,000 effectively, right? From roughly where we are. You could spend 2,500 on those 50,000 puts, okay? And know that if Bitcoin crashed, you're out of your position at 50,000. You've got no exposure, right? So if Bitcoin crashed to 20,000 again, you're laughing because all that money you made on the way has been protected because you had the right to sell it all out at 50,000, even though the spot has dropped back down to 20 or 30,000, right? So that put is protecting you. That put is insuring you against the crash in the price. Now it's only insuring you out to May, 28th of May. So if we don't get a crash by 28th of May, then you're going to have to buy something else with a later expiry, okay? But right now, if you're thinking what happened at the weekend is the beginning of something bigger, then you'd be thinking maybe I need to own some of this protection. Now, the truth is, Bitcoin options generally are not cheap, right? They trade on a high volatility, right? The way options are priced is through the implied volatility. And the implied volatility in the most simple terms is the market's expectation of how much this asset can move, right? And we all know that this asset can move a hell of a lot, right? So knowing that the option market knows that, the options market is not going to give you stuff cheaply. It's not going to give you insurance cheaply on something that can move a lot. So then you have to ask yourself, well, then is there a way that I can cheapen this protection that I want to buy, right? So if I want to buy puts every month because I want to be confident that I'm protected for the crash, what do I need to do to fund those puts? What do I need to do to get the money back if nothing does happen or if Bitcoin continues to go up, okay? And the way you think about that is, are there any calls that I'm willing to sell? Because you own the underlying asset. If you own the Bitcoin, then selling a call is just selling the right for someone else to buy the Bitcoin from you at a price above the current market. So if Bitcoin's here at 55,000, where do you think this thing's going to rally between now and end of May? Because if you don't think it's going to breach 80,000 or something like that, then you might be willing to sell the 80,000 calls, right? Let's see how much you get for those. The 80,000 calls, you can see, cost around $500. So if you sold the 80,000 calls in May against your position, you'd get $500 back, right? Maybe that's not enough. Maybe you want to sell something even lower down. Maybe you sell the 70,000s. What do you get for those? So the 70,000s, you're going to get 1,200 for, okay? So the idea being that if you can find a place where you're comfortable letting your position go, but thinking that the odds of it actually happening are not that high, right? Remember, 70,000 is a 30% rally from here in about 5-6 weeks, right? 30%. I mean, Bitcoin can do it, but it's a pretty good rally, right? So the idea is that you can buy protection by buying puts, but you can sell calls to fund that protection if you've got a good feel for how much you think this thing can rally in the short term, and you don't mind giving up some of that upside if it was to just smash through the strike. Yeah, because what, you look at the price action, right? Bitcoin, it has these big rallies, but it then retraces, right? It has the big rallies, retraces, has a rally, retraces. So yes, it might rally. You might get taken out of your position because you're short a call, but then wait for the next dip and buy your position back, right? So obviously your risk is that it just goes up and never looks back again. That is your risk. But the point is, that's the trade-off for owning protection, right? If you want to own the protection, if you want the security, then there's a trade-off, right? And so nothing's for free, and you just need to think about it that way, right? Now, another thing to consider is, well, what maturity calls do you want to sell? You might be saying, I want to buy these May puts because they look fairly cheap relative for the protection that they're giving me. And if we haven't sold off by May, then it's probably because we're just rallying again. So I don't need the protection as much, something along those lines. Then you might say the May calls don't give me enough premium. I don't feel like they're a good sell because I think there's good upside still in this. So then you look at longer maturities, right? And so, for example, June, what can you sell in June? If you sold the June 80,000s, you get $1,600 for those, right? So the idea is you can match your expiry, your risk tolerance, the premium you want to get, where you're willing to let go of the position. You can match all these preferences by looking at the different expiries, the premiums that they offer you, and you can kind of balance your goals and your objectives that way, basically, right? Anyway, I better look at the chat in case there's questions. Yes, so Deribit is not available to US residents, retail. I believe that is correct. Yeah. The other thing is you can do it on Ledger X. There's a platform called Ledger X, which is also an option trading platform. I believe that is available for US. Price to buy an option on Bitcoin instead of buying Bitcoin outright. Cool, thank you. Gives you a counterparty risk. Yeah, I mean, counterparty risk on Deribit, to be honest, they're flush with cash, it seems. Yeah, seems like they've got decent reserves. They've actually got this thing that they show you, which is called their insurance fund. So you can see here, they have got a pot that they have against, to protect them against like loads of traders being liquidated at once and like having big losses and stuff like that. So you can see this fund, it's just accumulating and getting bigger and bigger. It had a bit of a drop recently, right? When we had that crash, but it's got a lot of room, a lot of cushion there, right? So that gives you a sense for how well capitalized Deribit is. So personally, I don't feel like the counterparty risk is too concerning, not concerning enough for me to not be on it. But yeah, you've got to weigh up how you feel about those risks, right? Okay, so you've got the pricing here. You've got the bid offer we've already discussed, right? These are the prices. What else have we got? We've got IV. So what does IV mean? Well, IV is the implied volatility of that particular option. So you can see all these options have got their own implied volatilities, both on the bid and on the offer side, okay? So if that volatility number is high, then it means it's an expensive option. If it's low, it's a cheaper option. And the premium of the option is directly going to be impacted by that implied volatility going up or down, okay? And that implied volatility going up or down is a function of market expectations of the future, right? If markets expect further volatility in the future, then that implied vol is going to go up. If markets expect things to die down and not move, that vol is going to go down. Okay, so implied vol, big factor into determining option price. Okay. Then the other columns, we've got the size. So this is the volume, right? The volume available at that price. So how many you can buy or sell, right? How many you can buy, how many you can sell, right? In terms of number of contracts. Okay. Volume, that's the days volume that is traded on that option. there's the last price that option traded at in terms of, and that price is quoted in Bitcoin. So you can see for those at the monies, it traded at 0.385 of a Bitcoin, which is just a little bit cheaper than the current market offer. Okay. And you can work out what that is equivalent to in dollars if you want to figure that out. Yeah. Now, very important, the delta. The delta, one of the most important Greeks of an option. What does it tell you? Well, it just represents how that option is going to behave if the underlying changes, right? What is the current instantaneous exposure that option has to a move up or down in the Bitcoin price? Okay. So for the at the money option right now, that is 54%, 0.54 for those at the money calls. So what does that mean? What that means is if Bitcoin rallies from where we are now, 54,000 to 55,000, that delta suggests that the option price should move by 1,000, which is what Bitcoin's just done, multiplied by 0.54, and that's how many dollars that option price would change by. So that would be $540. So that price would go from $2,000 to $2,500, basically. Yeah, because roughly a 50 delta option. It participates in the move in Bitcoin at a rate of 50%. Okay, that's what that is basically saying, right? And that Greek, that is one of the option Greeks. It's probably the most important one, the delta. Okay, and that delta is not constant. It's not static. That delta changes through time for any given option, and it also changes when the underlying asset moves around as well. Okay, so that delta, and as you learn more about options, you'll understand more about it, and you'll understand what gamma is and things like that. But basically, just be aware, delta, very important part of how an option is going to behave, tells you a lot about how the option is going to move, basically, with respect to the underlying. Okay, and then the other thing that's not on here is the theta, which is the time decay. Okay, now if I highlight the delta, it will actually show me. It should do if let me just switch to this. There we go. It tells me the Greeks. So that says the theta of that option is 122 negative. So that's saying that each day that passes, that particular option will lose value. It will lose $120 of value per day. Okay. So if I buy that option and the market stays exactly where it is, tomorrow, that option is going to be worth $122 less. Yeah. So the passage of time costs you money when you buy options, basically, right? That's the bad side. Generally, being long options is a nice, comfortable position because you have lots of leverage, you have lots of exposure to big moves, you like volatility. Problem is when you get no volatility, option prices go down, right? And that's because of this nasty little thing called time decay. Yeah. So that's kind of in a nutshell what those columns are, and kind of what the platform looks like. Yeah. What else did I want to discuss? So yeah, that's what the platform looks like. Obviously, when you kind of double click on it, this trade box comes up where you put your quantity in. Let's say one contract there. And if I was gonna, that was the price that I wanted to pay. It tells you the margin that you need to buy it, which is just really the price you're paying for the option. That's the same as the margin. If you're selling it, you're gonna need more margin because there's more risk attached to selling it. So it tells you how much margin you'll need in Bitcoin in your account to be able to sell that option. And then away you go, right? You put your order in and you don't have to cross the bid offer. You don't have to always cross the entire spread. You can change that price and go into the middle of the spread and hope to get filled. And that's what I generally do when I trade these options. I don't just cross the spread because there's no need to generally, unless you're really, really desperate to trade very quickly. Yeah. All right. So that's kind of the platform. Any questions quickly on the Deribit platform before I move on to something else? Once you kind of know how options work, and I'm not saying you suddenly do after this short sort of webinar, right? But, the idea is you need help to guide your trading decisions, right? So when you're trading options, because there's so many moving parts like the volatility and the time decay and all this stuff, you need to have a way of knowing whether things are cheap or expensive and what the underlying risk is of certain option positions. So for that, you need analytics, right? So you need volatility analytics, and that's where this comes in, right? So volatility analytics, this is a platform, this is a free platform, company called Levitas. There's also other ones. There's one called Genesis Vol as well. There's one called Skew as well. There's a bunch of platforms, but this one I think is good because it's all free. There's quite a lot of information there for free. But what it does is it shows you what the volatility surface looks like, right? And it gives you metrics that you can monitor to get a flavor of where things are in their range, where they've been for the last year, whatever it is. How much is what is the realized volatility versus the implied volatility? You know, it helps guide your decision about whether you want to be long or short vol, basically. Here's an example of the skew surface, right? So if we go to May and we go here, full screen. So this shows me that versus yesterday, what has the skew surface done, right? So what is the skew surface? What that means is the volatility for one particular expiry across all the strikes that exist there. So you can see that today, the vol is lower than it was yesterday by almost 4 vol points, right? For the at the money, because around that 55 area, the difference between those two curves. But then you can see where it is on the wings as well. So on the wings up here on the 100,000 strikes, it hasn't dropped by as much, right? So it's been more, do you see what I mean? So you can see what it's doing across the whole surface, and you can see that graphically, and that's quite nice, basically, right? And it kind of helps guide you and understand what the surface is doing and what's going on, right? Because in vol trading, you've got this 3-dimensional vol surface, which basically means that volatility trades at different levels for different maturities and for different strikes. So you've got this thing called the term structure, which is this. And this shows me the volatility level for every expiry. So it shows me April, May, June, you know, all the way out to March next year. And you've got the shape of that term structure. And again, the shape of that term structure will vary and it will move around, right? And you can actually have an opinion about how it's going to move, and you can take positions on how you think it's going to move if you want to trade volatility, basically, right? So yeah, those kind of things that you need to be aware of and you need to look at and think about when you're trading volatility. Yeah. So, you know, and then once you really understand how options work and behave through moves in the underlying price and the passage of time and moves in the implied volatility, then you know, those tools are going to guide you as to what the optimal strategies are to reflect your view. Okay. So an example would be you want to buy calls, but volatility is at the top end of its range and you think it's susceptible to a drop. So then you won't buy calls. You'll buy call spreads because they contain less vol, right? They contain less Vega exposure, which is your exposure Greek to implied vol, right? So, you know, in my courses, I've got this option mind map that helps show you like what exactly, how you can identify which optimal strategies are for you based on your volatility view and your spot view, basically, right? So these are the kind of things you need to think about, yeah? Okay, so then the last thing is, you know, if you want to learn more, then, you know, these are kind of your options, really. So, you know, if you found this interesting, you want to get into options, you want to explore this in a bit more sort of detail, then that's kind of what I'm here for, right? So, the things that I'm kind of offering at the moment are a crash course, which is a 2-hour webinar. And the idea is, it is what it says on the tin. It's a crash course. You're not, you know, you're going to get a 2-hour kind of feel for what are the most important concepts around options. It's going to help you build a foundation to develop your option trading skills. The kind of topics that we're going to cover are the basic payoffs. So it's good for beginners, right? It's perfect for beginners. It's going to go through the basic payoffs, the combined option strategies, all the different ones that there are, why you would do them, what impacts the price of an option, breaking an option's value down into intrinsic value, time value. We're going to briefly touch on the Greeks, because remember, we're getting through a lot in 2 hours. Briefly touch on the Greeks, talk about term structure, talk about skew, similar to what we've done today, but obviously in a bit more detail, getting stuck into the theory there. If you are one of Deb's SPA clients, then obviously there's a code there which will give you a discount on that crash course. So feel free, sign up there. You should all have an email in your inbox as we speak, right? You should already have it, which has got all the links to all the products, basically, all the offerings. The other more, if you want to go deeper, if you're not a complete beginner, you've got some feel for options, but you want to really understand from a practitioner's perspective how to think about this stuff, how to understand it intuitively, and how to really make money out of it, then Intro to Options is your best bet, which is my weekend course. That basically covers my whole syllabus of options. It's 2 full days, like 5 hours of training per day, 2 full days of training over a weekend, and that's on the 15th and 16th of May. You also get a 1-month membership to my Macro Insight if you do that course. So my Macro Insight is basically my subscriber service, part of my trading community, where I basically handhold people through the markets, right? So I put out, I don't know if you guys check out my YouTube, but I put out weekly videos about what's going on, talk about my own trading, my own positioning, and I help guide people about what they want to do with options and what they're thinking on markets, basically. So if you do the courses, you get a 1-month free subscription to that. Yeah. And then, if you're still undecided and you're not really sure what's right for you, then jump on our website and have a chat with us. And we'll kind of, find out more about you, figure out what your sort of level of experience and knowledge is at the moment, what your goals are, what you're trying to get out of option trading, and figure out, what the right course would be, what the right fit would be. Yeah. So that's kind of it, really. I mean, there's also one-on-one training, which people have been doing, but that's the higher price point, one-on-one training. That's more for specialists who are already running their own money, running their own portfolios, and just kind of need some tips and tricks and kind of want to figure out what the professionals do, basically. Yeah. Yeah. So that's it. Any more questions on the chat? Cool. So I hope you guys enjoyed that, and I hope that was useful. And yeah, hopefully we can connect and have a chat with you soon. Yeah. Debs, you got anything to add, mate?
No, that was really, really good. That was really, really good, Imran. Thank you very much for that. Yeah, I definitely urge people to do the course. Imran's, I don't know how much you actually know about Imran, but I've worked in the city for nearly 12 years, and some of my mentors, Imran, used to work for Imran. So there's a lot of experience there, and you're going to learn a lot, especially if you already know a little bit about options already. You definitely should be taking this opportunity with both hands, because you've got someone who's actually worked on the institutional side, and also who's worked on the managing his own money. And this is an opportunity that personally, you don't get many people who've got 20+ years experience doing this kind of thing, running these kind of courses. A lot of the guys on YouTube, a lot of the other guys, they know a bit of what they're talking about, and they know some things, but they won't know it to the level of someone like Imran. So definitely, if you're in a position to take advantage of this opportunity, definitely do it. And I mean, you're doing something right if you come on here what we've done today is not an intro, right? It shouldn't be free. If I'm being very honest with you. So that's why I'm very grateful that Imran's even doing this and giving people the opportunity. I'm surprised how many people haven't grasped this free crypto options seminar with both hands. But we get an edge. You definitely do get an edge, because this using options in crypto is still very, very new. So if you can get a grasp of it very early, you're going to have an edge over everyone else who's still trying to figure it out. So yeah, thanks for that, Imran.
Yeah, pleasure, guys. No, I enjoyed it. It was good. Nice to meet everyone, and